Welcome, everybody. Really excited to have you join our demo day, and in particular, our Fireside or bookcase chat with two great friends of the FinTech Lab, Matt Harris of Bain Capital Ventures and Carrie Davis of Warburg Pincus. Let's start with general trends. According to our friends at CB Insights, the first quarter of 2021 had the most venture dollars going into FinTech since they started tracking it, which was I think the first year that they were in the FinTech Lab. So let's start with what's behind that. What's driving the fact that there's so much money piling into FinTech, even as we're coming out of a pandemic? Carrie, why don't I start with you?
Sure. I'm sure all of you have seen Satya's quote that we've accomplished 2 years of acceleration of digitization in the banking world in 2 months with the pandemic. And I think that you lay that against the fact that most of the banking industry's tech stack was built in the 60s, and you have an industry ripe for transformation. And banks have sort of put that off for a long time. And with zero interest rate environment, they're not really making a lot of money and don't have the wherewithal to spend on completely renewing their tech stack the way they used to. And so I think that that's the big driver. And that leads to a few things that we're focused on, but Matt, you might want to comment on the overall environment first, and then we could talk about the themes that we're looking at as a result.
I think it's not so much in spite of COVID as it is because of COVID. It really, for all of us for a quarter or two checked up, but then it was Katie bar the door and investment ramped up, both corporate investment, like Carrie describes, and relatedly, growth equity and venture investment, and not just banks. I think insurance companies, perennially the laggards in IT investment have got the memo that they too need to keep up with the insurtechs and rising consumer expectations. Broker dealers, asset managers, it really is across the board.
And are there any of the subsectors that have seen more investment than others that you want to sort of call out?
Sure. Payments is the perennial leader in this regard. I personally, though, have observed that it's really late stage payments companies raising scale capital. We're actually seeing fewer raw startups in payments. And I do think increasingly we're running into some, fair share of solved problems in payments, not all of them, but there's less wide open space, I think, for payment startups. When I contrast it, for instance, to insurance, there are some sort of bold-faced names and insurtech, public companies like Lemonade and Root, and insurance technology companies like Duck Creek. But the fact is, most segments of insurance remain very untransformed, and there are still big problems to be solved. So we're seeing more heat. And certainly we're spending more time on early stage insurtech than we are early stage payments.
And Carrie, what are you seeing?
We've been focused a bit more on a horizontal theme of embedded fintech. And it really started in the payments world where you have point of sale merchants getting solutions where the payment flow is embedded into the software solution, and they were given the software for free in exchange for getting to keep the interchange. And that really disrupted the fact that the vendors who sell software solutions and weren't capturing payments were at a disadvantage because they were trying to charge for their software, and the banks that were collecting the interchange don't really have the ability to provide the software. And so it was hard for either set of competitors to compete with that. And we're starting to see that in insurance and a variety of other sectors where especially where there's more knowledge about the customer, you're able to be more disruptive to the incumbent players. There are a lot of regulations around what consumer data you can use to make decisions, such as lending decisions or insurance decisions, but you can't use the data to discriminate. But what you can do is offer people who you screen and appear to be attractive to you preferential rates. And so if you know that a certain customer, or have a strong belief that a certain customer is likely to be a better credit risk than their FICO score would entail, because you also have access to their transaction history for the last 5 years and they don't bounce checks and they routinely deposit a paycheck, then you might be willing to offer them cheaper credit than they could get in the open market. And similarly in insurance, if you had some way of knowing somebody was a good driver or was healthier, you might be able to offer them something that was a benefit to them without discriminating against people who were applying.
And we'll come back to the whole question of data, because there's a lot to delve into on that one. But keeping with the current environment, how sustainable is this, these high levels? Is this something that you think this is going to be a peak? And I know I'm asking you to each get out a little bit of a crystal ball on this one, but is this a peak? Do you think the high level of interest is going to continue from the investment community?
Well, I think there's two phenomena that are interrelated. One is the volume of funding, and the second is the valuations at which that funding is taking place. I think in terms of volume, when measured against, global market cap of financial services, it doesn't jump off the page. I mean, I think if you believe, as I do, that all of financial services globally is being disrupted by technology, and you put the numbers in that context, you look at, say, the funding for Nubank in Brazil, and you think, well, it's actually now the largest financial institution in Brazil. It's not crazy that Warren Buffett would invest hundreds of millions of dollars in the largest financial institution in Brazil. So I think contextualizing it relative to the market cap of global financial services, so 20% of global market cap overall, I think these numbers can be sustainable if you believe that technology is going to kind of keep marching. And I certainly view that as an article of faith. I think the more worrisome part for us, probably for Carrie as well, is the valuations, which don't seem sustainable. I think we've seen an evolution of private capital to where there are a set of players who are, aggressive in an unprecedented way on valuation and in terms of how quickly they move. And that is clearly behind the growth in funding, but more so and more worrisome, it's leading to a sort of brittleness around the cap tables of some of these companies and the private market valuations. And that, I think, if there's going to be something where we look back at 2021 and shake our head and regret sort of an over exuberance, it'll be less about the volume of funding and more about the values.
Interesting. So Carrie, if you could also speak to the U.S. versus international, and are there, as you look at the world, because I know Warburg in particular invests globally, are you seeing more fintech opportunities globally outside the U.S.? Is it equal? Talk to us about that differential, if there is one.
Well, there are substantial opportunities globally. We're seeing plenty in the U.S. as well. The European financial institutions tend to be a bit more country-based, and therefore they tend to be more modest in size than the US institutions. And also their regulators tend to have more open views about how data should be used and who owns it, which also facilitates innovation in the next generation of players. So bank charters are easier to get in the UK and on the continent, and there's open banking laws that require that the banks share your data if you ask them to with whichever vendor you want that data shared with. So that fosters a bunch of innovation that's a little harder to come by here in the States. And in Asia, there's tremendous opportunity, but again, the markets there are quite different because they just jumped past an entire, probably couple generations of financial services and tech infrastructure and ended up at a very different endpoint because they don't have a whole bunch of legacy stuff to deal with, and their products are different, and they've actually got a smaller number of huge behemoths that you've got to figure out how to dance your way around.
Interesting. Let's leave the broad trends and delve down now to a couple of very topical areas. And I feel like we have to start with digital assets, given all that's happened. So you've got the fact that the FBI was able to pull back some of the ransom, the Bitcoins from the Colonial Pipeline ransomware attack. You've got the Basel committee's just come out with some recommendations around what the capital requirements are for banks to want to hold Bitcoin. And they put crypto assets at the very high end of where capital requirements are. And El Salvador's adopted Bitcoin as legal tender. So Matt, let me go to you for this one. So what's the impact of these three things, particularly the first two, on the Bitcoin market, the future of it as a asset class, if you will, held by regular investors versus more speculative holders? So what are your thoughts on this?
I think they're consistent with a broader pattern we're seeing, which is increasing maturity in Bitcoin specifically, and Bitcoin alone, by the way. The rest of crypto, in which we're also very involved, by the way, is at a far earlier stage of maturity, is, could be fairly described as the Wild West. By the way, a lot of fun and interesting things happen in the Wild West. That's not a criticism, but it is just a fair description of the level of volatility. But Bitcoin itself surely has price volatility, but as an industry, as an asset class sort of unto itself, as digital gold, just by way of shorthand, I think it has reached a new plateau of acceptance. I think the fact that it's no longer quite so useful for criminals is a good thing. That is definitely a feature. I think the fact that it is given a very high, the highest risk rating by the Basel Committee is amazing. That the Basel Committee is thinking about it, and feeling like they have to grapple with it. So I think these things all represent positive trends in the sort of Bitcoin is here to stay. Now, whether it's 40,000 a Bitcoin or 4,000 or goes up to 80,000, all those things are quite within the realm of the possible. But I think, there's more and more indications that Bitcoin will be, in the pantheon of assets for folks and institutions to consider investing in. And the last thing I'll say about it is one area where New York City is just unquestionably the dominant player between DCG and BlockFi and NYDIG and Galaxy Digital. And I mean, it really is the epicenter of particularly the Bitcoin economy in a way that I think stands to reason, considering Bitcoin as an asset class. Like, where else would be the home of a new financial asset class?
As a long-term store of value, there are many things that you want, or especially if it's going to be digital gold. And you want price stability. You want ideally something that's counter-cyclical. And Bitcoin has been highly and relatively stable. Bitcoin's been highly volatile and highly correlated with the equity market, as opposed to opposite to the equity market or stable. So as a long-term store of value, I still struggle with seeing that as something that might underlie transactions. I have an easier time seeing how that is helpful. Somebody said currencies need armies, and I still am a bit of a believer in that. And the Basel Committee, I think that the central banks are going to do everything they can to fight this, right? The US government, as the reserve currency, will do everything it can to fend off against any other possible reserve currency.
The majority of the financial institutions in this year's FinTech Lab actually asked for solutions around ESG. And it was the majority, I would say a good 60-70% of them were looking for new solutions. And that was definitely something new for this year. So I want to spend a few minutes talking about that. And two of the companies in this year's class are focused on this ESG space. So what do you think is driving this interest in ESG?
There's a generational shift that's behind a lot of it. Like, for instance, at Bain Capital, we've invested a huge amount in our internal ESG, both really all three of those dimensions: environmental, of course, but also elements of social justice, particularly here in the last 15 months, and then governance, which has been a core part of really any private equity firm, but certainly we see it as one of our core differentiators. So we have leaned in part because our customers, limited partners, do expect it of us and demand it. And that's driving ESG everywhere, which is the customers. But in our case, even more so, it's the employee base. People want to work at firms that reflect their values. And increasingly, as our workforce is made up of 20 and 30 and even 40-year-olds, they belong to generations where they expect work to reflect their values. So I think there are lots of pressures on this by these younger generations who grew up espousing these values and expecting them from the institutions at which they work and from whom they buy asset management products and all sorts of products. And I think you could comfortably say in generations past, as Churchill did, that people tend to be liberal when they're younger and grow more conservative as they age. We haven't seen that in some of these latest generations, and perhaps that reflects a growing deep and abiding concern about the environment in particular, which is not getting better and is not sort of something we can just put aside and move on and start focusing on more material things. So I think there are meaningful societal and environmental challenges that are increasing, not decreasing, do not seem to be cyclical, seem to be secular and growing more troubling. And we have generations now who can't set those issues aside. So I have concerns, to be clear, about ESG in investing. I think it is a very complicated matter. We have an impact fund at Bain Capital. I serve on the investment committee and have for 7 years. And we've worked incredibly hard to balance what do we mean by impact and how do we balance that with return? And in particular, in our case, how are we entirely non-concessionary about how we drive return while driving impact?
Yeah, because data is a big part of this. Is how what are you measuring and how do you measure it? So Carrie, what are you seeing in this space?
I agree with all of Matt's comments this time, and I think that it goes one step earlier in terms of the pressure for ESG. It's not just our investors, but our investors are hearing it from investment committees and individuals who are asking for what is the ESG profile of the managers that they're investing with or the funds they're investing in, and we're hearing it from investment committees as well, and so that it's an increasingly important thing driven across. I think that creates what we're most looking to do is great utility business models. So there's data collection, data sharing, analytics and evaluation, think almost ISS for ESG and across many stripes of different types of investing, and how do you evaluate having some third-party marker of how well you're doing on the ESG front will be really useful to investors, because it'll be impossible for each investor to evaluate every different opportunity and come to a point of view on that.
Included within ESG is sometimes financial inclusion. And it's obviously something that we at the Partnership Fund, think a lot about. So wanted just to spend a couple minutes on that. And there's a little bit of a quandary, right? So as the financial sector moves towards more digital payments and the use of digital tools for payments, you've got a segment of the economy and the population, the un- and underbanked, which are heavily cash-based. And so how do you balance and moving towards a more digital society, but yet not leaving that population aside? And there's some political implications for this, because you now are starting to see municipalities passing laws prohibiting digital payments because they've got a bunch of constituents that are not able to participate and are cut out of buying things at a particular retailer. But Matt, I know you've thought a lot about this issue. So what are there some good tools that we should support or be aware of to solve this problem?
Yeah, I think, the cash preferred unbanked, underbanked segment is among the needier segments in our population. And so we need to be incredibly thoughtful about not discriminating against that population. That said, cash is like the original Bitcoin, right? It's not a good thing from a policy perspective. It is untraceable, and it is actually the primary tool used in crime. And so I think we as a society need to move to more fully digital methods of payment from a safety and soundness and taxation perspective, and really all of those things, which I think we can all agree are important values. So how do we do that fairly? I mean, a lot of the benign reason for cash preference is the products available to this population has historically been atrocious. They've been extremely expensive in it's very expensive to be poor kind of way. But we can understand that. It wasn't like anyone was making huge money off this. The cards available from the major banks to this population had high fees and overdraft risk, et cetera, because they couldn't make any money otherwise. So to me, the solution is companies like Varo and companies like Mochify, who are building products that are just fundamentally different from a cost structure perspective. And so can offer very high quality, in fact, much higher quality than most of the kind of retail banking products offered by major banks, with none of the fees and none of the sneaky risks like overdraft.
Let's move over to the data privacy space. One of the burning questions, which is who should control an individual's financial data? And what restrictions should there be on how it's transferred, what's done with it, who has access to it, et cetera. So what are your thoughts on that sort of major question of our time?
So I firmly believe that the data should be the property of the consumer and not the financial institution, and the consumer should decide where and how the data gets used. And that is not the current stance or posture of the US regulators, but many of the European regulators have come to that point of view. And it's great at entrenching the current players because it makes it hard for competing products to come into the market and pick off customers unless they wholesale move their accounts. But it stifles innovation and next generation players.
In the data space, Carrie, what are some interesting investments that you've been working on or seeing?
We've been investing broadly in data infrastructure, but in particular around this consumers being able to use their data or how they benefit from their data. Companies are doing that, right? Borrow, for instance, which Matt mentioned earlier, as the neobank with the charter, they were able to use a consumer's financial history in making in deciding who to offer certain new products to. Again, with premium offers as opposed to something that would be discriminatory because people were applying and you were deciding not to give them something.
So I'm going to switch a little bit to another topic area here. What are the subsectors in financial services that you think are the most ripe for disruption over, let's say, the next 2-3 years?
Lately, I've been spending a lot of time on asset management because there's clearly been a lot of activity in wealth management, starting back with Betterment and Wealthfront, both of whom are, a decade old and obviously at scale. The sort of robo-advisor movement, SigFig, et cetera. Again, lots of great founders toiling away for a long period of time to change how we receive advice on how to allocate our money, et cetera. But in terms of manufacturing products, the business of BlackRock and Fidelity and T. Rowe and, Warburg Pincus, those industries, those companies have been like, name one startup who competes in asset management. The historical belief is that it takes, decades of trust to build a brand, for, companies to buy your products, et cetera. I'm increasingly skeptical of that. I think there are really interesting models built on, the fundaments now of fractional shares and lower costs of trading, lower costs of compute. You can run individualized portfolios for investors as an asset management firm. It looks a lot like wealth management, but it has the economics of product manufacturing, those incredible incremental margins at scale.
And Carrie, are you investing in the disruption of venture capital? Just sort of or are there other areas that you're looking at for disruption?
I'd have one, I completely agree with Matt's comments, but would broaden them a little bit to say, each generation of technology tends to bring about both a bunch of vendors that are leveraging that technology to sell to established players, be it in financial services or other markets. In energy, I think we're seeing a lot of activity against the banks, where the cost structure of a neobank is just so much lower than the legacy banks that as Matt well articulated. You don't need to charge the same fees to make a customer profitable. And that then opens up 150 or 200 million customers who can be served by the majors, but they're not profitable to the majors, which is why they charge all those fees. They're not doing it because they're trying to be usurious. They're doing it because otherwise it's uneconomic for them to offer those accounts with their cost structure and their inability to have real-time systems to manage losses. So broadly speaking, I think we'll see this we're seeing it in insurance now. Matt mentioned Lemonade and other vendors that are cropping up to do that. And then one other area where I think has historically gotten less attention, but is sort of Matt and my business, not with direct competitors in our business, but the whole private markets. And, we still work by phone and spreadsheet, and, everything around us has been automated and digitized and become more efficient. And if you looked at our business processes, they are not. So
still paying Microsoft for Excel. Yep.
But Carrie, you and I are such precious snowflakes that we can't be automated or replaced. I mean, unlike every other industry in the world, you and I mean,
you guys are both special. It's true.
Thank you. I needed that validation.
I hope you meant that in a positive way.
I did, yes, only positive. Now we have to talk about SPACs. Why have they been all the rage? Why so widespread? And are we at the end of that trend?
Well, I sit here as a beneficiary, just I know as Warburg is and as the partnership fund is, we'll take ultimately 3 companies public via SPAC this year, just in FinTech alone. I think boards have matured their conversation about what a SPAC is and what it isn't. It's frankly just an alternative method of getting public that is more expensive. It's not as expensive as it was in the days of unnegotiated sponsor promotes, but it's a more expensive way to get public. It helps companies who really need to tell a future-oriented story versus just here's last quarter and our history. And there are a number of companies, young companies, who need that in order to get the valuation that they feel they deserve. And it offers, enhanced timing and certainty, at least in my experience. So I think it has a role in capital markets. I think just like everything, the exuberance just got like massively carried away. And there's way too many sponsors out there. And I think some really good percentage of them are just not going to ever find a target. The threshold is quite high, higher than it was even a couple months ago to get a deal approved and get a deal funded. And again, fewer and fewer of these many sponsors against a narrowing target pool are going to find acceptable transactions to do. So I think this is the air whistling out. This is my favorite way for bubbles to end is air whistling out. There are way worse ways for bubbles to end, and sadly, I've lived through a couple of them. So if this is, how SPACs kind of, die with a whimper versus with a bang, and they don't even die, they just get relegated to, a relatively narrow proportion of companies coming public.
Gary, your thoughts on SPACs?
There's some category of companies that are relatively lower growth that would be perfectly fine public companies, but won't generate the kind of excitement by traditional IPO buyers. And so they really just didn't historically have a path to go public. And so for those companies, SPACs are really valuable, even though they are expensive to do relative to a traditional IPO, although I think that they'll end up coming a little more in line. The second point that Matt made about the fact that projection-oriented companies do that, there's a bit of regulatory arbitrage at the moment where traditional IPOs are not allowed to share projections, but SPACs are. And I find it hard to believe that regulatory arbitrage will persist, and that regulators will either say that regular way IPOs can share projections, which they probably won't because they really slap your wrist when you do anything that might look like a projection. And I think more likely they lock down SPACs' ability to share projections and level the playing field there. Level the playing field there, which I think will take out quite a bit of the exuberance for some of these vehicles.
Yeah, the FinTech Lab, which we set up back in coming out of the financial crisis of 2008. The goal was to help make New York City a center for FinTech. And New York's obviously taken a bit of a blow during the COVID-19. So just give us your thoughts on the future of FinTech in New York, FinTech and InsurTech in New York.
I'm really bullish. I think overall, the fall is going to be like the Roaring 20s. And I think it's no accident that the Roaring 20s came after the 1918 flu pandemic. So, right, people have been cooped up, unable to do things. I think that, there's going to be a snapback come Labor Day, assuming no variants go rogue. And so I think it won't be exactly the way it was, but I think there'll be a lot of energy and a lot of people back in the city. And, part of the reason you set up the FinTech Lab originally, Maria, was that New York has, if you do Michael Porter's 5 forces, right, it has comparative advantage in financial services broadly defined. And if you're looking to sell to financial services firms, they're all here. And I think that New York will remain one of the most attractive places for FinTech companies to locate themselves, or at least have a significant presence, because it puts you right in the pocket of so many of your customers.
Glad to hear that. Matt, how about over to you?
Happy to agree. And I would also add that, the advent of, digital methodologies for work basically means that people get to choose where they want to live more and more, not sort of to the limit, but more and more. And to my mind, that helps New York City. Like New York City's talent value proposition for people in their 20s and 30s is unbelievable. Like, is it for everybody? Can everybody make it here? Probably not. But for those who are hyper competitive, who want to win in the most competitive market in the world, who want to have the best of everything and be in the game, be in the arena, there's no better place than New York City. And so I think in a fair fight in terms of talent, I think New York City's value proposition for that talent is unique, differentiated, and we're going to be a winner.
We may put you both in a PSA, so stay tuned for that. All right, we got a couple last questions, but rapid fire. So one word or one sentence answers just to round off our fireside or bookshelf chat. So name one FinTech trend that's overhyped and one that is below the radar that people should pay attention to.
I still think blockchain is overhyped, just as a nonsense concept that corporations like to mutter. Underhyped decentralized finance, the flip side of that coin, protocols and tokens.
Okay, Carrie?
I'll move to SPACs.
Okay. And how about under the radar?
Overhyped and under the radar would be the area that I mentioned before where we're spending a bunch of time, which is how private markets are on the path to being automated.
Okay. Great. What is one thing that each of you started during COVID that you think you're going to continue? Carrie, over to you on that one.
I don't think I will be in the office 5 days a week anymore. I think I will be there 4 days a week.
And Matt?
Dinner with my kids and lunch some days too, although I expect that'll go away. But it's just a function of traveling less and recognizing that I can do first meetings over video versus, flying to Kansas City for a 45-minute session.
So one piece of advice as those FinTech and InsurTech entrepreneurs look forward to what will hopefully be a roaring time in the city, lots of money coming in, but one piece of advice for them sort of with that framing. Carrie, over to you.
I would say seek out your critics. Try and find people who are telling you that what you're doing isn't right or isn't going to work or has a problem, and not because you have to believe them and not to depress you, but the more that you can iterate and listen to people who have criticism of what you're doing, the more you're likely to tweak to a path where you're going to be successful.
Great piece of advice. And Matt, piece of advice for the entrepreneurs.
Think about diversity starting with your first hire. I think many companies think about it when they get to 100 employees and say, oh boy, we got a problem. How do we solve for diversity? And I don't mean just racial and gender diversity. I mean diversity of thought, diversity of educational background, socioeconomic diversity. You'll have a much better company if you start incorporating that into your hiring from the very beginning versus trying to retrofit it on a scale company.
Great advice from both of you. And I think we could do another session just on advice from Carrie and Matt. But we're going to call it a wrap right here. Thank you guys both for joining us this morning. Appreciate your comments, your commentary, your support of the FinTech Lab, and all the great work that you're doing, investing in companies in New York to help make New York a great tech center. Now we will go back to finish up the balance of the presentations for Demo Day, and hopefully we'll see you all in the breakout rooms this afternoon. Thank you very much.
Maria, congratulations to you for having launched the lab. It's had a big impact on New York and FinTech in New York, and it's really gratifying to see how it's grown and flourished over the years.
Thank you. I hope you enjoyed that really interesting discussion with Matt Harris and Carrie Davis, two great venture capitalists who've been wonderful supporters of the FinTech Lab from the beginning, and had some really interesting things to share about the sector and also the future trends.